Have a listen to this. Have a listen to this.
Now, that kind of talk this week dragged Australia's share market to a two-year low. There are, of course, complex reasons for that.
He was the big spender. The big spender.
Doing the grocery shopping could take a huge chunk out of the family budget.
And that's finance.
Hello and welcome to Comedian versus Economist. We demystify the world of money and help you get a handle on the bigger picture. My name's Adam and we're joined as always by my little older brother and real life economist Thomas. Hi Thomas.
Yeah, g'day Adam. How you doing?
I'm very well, thank you. Don't forget there's still time to register for the ASX share trading game that we're taking part in. We'd love you to join in with us. Gameplay starts on the 3rd of March, so make sure you get signed up, get registered and have a bit of fun along with us. But Thomas, massive show coming up, lots to get through. We're going to be taking a look at buy now, pay later companies, and they're actually set to join Married at First Sight next season as they attempt to find love again, having found themselves totally unloved by investors. We're going to take a look at what's going on at Lark Distilling. Turns out not everybody likes ice with their whiskey. The Aussie dollar is falling. Gary sent us a message at CVE Podcast and wants to know what that means for buying US stocks. And you know the property market is out of control when a doghouse is selling for $300,000. We'll take a look at why that's selling for so much. But first, Thomas, everyone's panicking about inflation, not BHP. They've rolled out the iron carpet, it would seem. What's the deal there?
BHP reported their results. Good result for BHP. They're pretty happy. The underlying profit of $9.7 billion in 6 months. That's
wow,
not a bad hourly rate if you calculate that. They bumped their dividend too. So analysts were expecting $1.24, US $1.24 per share, but they bumped that up to $1.50. So yeah, nice if you're owning BHP shares. But they're saying the strong results obviously driven by iron ore prices, which is through the roof, but also for coking coal and copper prices. So yeah, they're riding the commodity boom. I think their share price is up 25% since November.
What's BHP making these days? They're still just in digging up the ground? Because if you look at their ads, have you seen any of their TV ads?
No.
They're like, you'd swear they were in renewables. Like, there's like sunshine and green trees and leaves and like, you know, I'm going to say that they're kind of, maybe it's a bit of a stretch. Obviously, it's a conscious effort to rebrand themselves. But they're kind of like, you know, we're getting all this electricity from the sun now and it's our copper that's helping, you know, shift that electricity around the grid. It's kind of like, yeah, I get it, but it would be like melting asphalt to make the roads and then claiming that you're behind the electric car revolution, you know, like.
It's got to make it happen. Yeah, I don't know. I mean, ESG is definitely a thing. Like investors are putting a lot of pressure on companies. We saw that with Cannon Brooks and the AGL takeover this week. It's pretty nuts. But yeah, it's like I think companies are feeling the pressure and they've got to sort of at least rebrand to be a bit greener, if not deliver some results. But I don't know what BHP is doing on that front.
All right, so you're getting $1.50 per share, and share price is $48. So that's 3% already, just on dividend alone. That's pretty sweet.
Yeah, it's a good result, and they're pretty bullish. They were pretty, you know, I mean, obviously the commodity prices booming along are pretty good. They did mention that there's industry-wide costs are putting pressure on profits, saying that some commodity-linked uncontrollable costs have gone to record highs, and they're expecting the cost profile to remain challenging through the 2020 calendar year, particularly around supply bottlenecks. So inflation's, you know, definitely having an impact. But they reckon, the chief executive Mike Henry came out and said they're looking at a decade of inflation. He said, do we expect there to be a degree of permanency to this? Certainly yes, he said. But he thinks it's going to be, we think that demand-led inflation, so we're, at the moment we're in a supply shock. It's supply side stuff, it's bottlenecks in the supply chains, all of that. That's what's driving price increases. But he sees it moving to more of a demand pull inflation where there's sort of so much heat in the economy that starts driving prices higher. And he reckons that's broadly positive for commodities. So as the economy ramps up, people need more commodities to do the economic stuff they do, and that's good for BHP. And so he reckons that BHP will be able to stay on top of their supply chain cost pressures, and then ride the wave of greater demand in the economy for good times ahead.
Right. So inflation's is posing a problem for a lot of companies, a lot of organisations, but they're just kind of saying, no, we're running a really tight ship. We're on top of it. We can handle any of those increases in cost, and just keep smashing it.
Yeah, pretty much. Yeah, that's the idea. I mean, commodity producers are nice in the sense they're at the top of the supply chain. Like, they're not totally dependent on. I mean, they face labour costs and some other sort of costs, but largely it's just digging stuff up out of the ground and shipping it around. And so that, like, economy-wide price pressures don't hit commodity producers as much as they might hit like tech manufacturers or something that are sort of more in the middle of those supply chains. So it's generally sort of good for commodity producers.
And what's their reliance on, like we've talked a lot about China on this show and struggles of Evergrande and the potential collapse of the building industry in China. So what's China and other countries' kind of role here? Like, does BHP have a reliance on those countries for success?
Yeah, I mean, it's definitely been a big part of the demand story is China's build out. Like, particularly, you zoom out and look over the past 20 years, the massive urbanization of the Chinese population, that's been, and all the building that's gone along with that's been incredibly supportive of commodity prices and really good for companies like BHP. There is a sense that might be unwinding now. Like, new property sales in China are just through the floor now. Like, the property sector's in a massive freeze, not quite a crash yet. So yeah, that's got to be weighing on the outlook, you would think. But so far, iron ore prices are still soaring. Like, commodity prices are quite high at the moment. So it doesn't seem to be the China story doesn't seem to be impacting that just yet.
I saw an article the other day that China was building this. Well, I think it's Guangzhou Evergrande was is the soccer team of the Evergrande company. So they had big future ahead. They were building a stadium that was gonna be bigger than Wembley. It was going to be the biggest football stadium in the world, and they've just canned it like 1/3 of the way in. They're just like,
wow.
Nah, we're just going to park that. So there's just this massive unfinished stadium. Which who knows if it'll ever get completed. Yeah. Anyway, did you have anything else you wanted to mention about BHP while we're looking at it?
No, that's it. That's all I had.
Pretty boring break, all in all. Moving right along. All right, we're going to take a look at Buy Now, Pay Later, and once they were the darlings of the ASX, now they definitely seem like they're on the nose. What's going on with Buy Now, Pay Later?
Yeah, so Buy Now, Pay Later as a sector is a bit exposed, it seems. I'm reading a bit of analysis lately saying that Buy Now, Pay Later is a bit exposed to rising interest rates. Because you think about their business model, so they borrow at sort of the benchmark rates plus a premium, depending on the credit quality of their loan book. So so it's like so those floor interest rates plus a margin. That's what they borrow at, and then they lend that out effectively, even though they're not technically providing credit, but they lend it out to their.
For anyone listening, you can't see Thomas. He's just done about 6 air quotes in a row.
So they're lending out in quotes money to their users, and then there's sort of a margin there that they get, even though they're not receiving interest. A lot of them just receive a service fee. Yeah, but effectively they're in the credit business and their costs are rising, but because interest rates are rising. So yeah, like the bank bill swap rate, that's sort of one of their anchor rates. That's up a full 100 basis points. So that's their costs are rising, but they're not able to fully pass that on to their consumers, partly because of their fee model rather than an interest model, and some other sort of reasons. But so it basically means that their margins are getting compressed. When interest rates go up, their margins get compressed. and that means that they become less profitable. So a firm who's a big buy now, pay later company in the States, they reckon that for every 100 basis points interest rates go up, those benchmark rates go up, they see a 40 basis points fall in their profit margins. And so falling profit margins, obviously not a great story. And a firm's results were interesting, their recent results. So their revenue was up 77%, and their active users were up 150% to 11.2 million. So on those numbers, that's going great guns. Revenue up 77%, active users up 150%.
This is a firm, the US buy now, pay later one of the giants in the US, right?
Yeah, that's right. Yeah, so those should be great results, but their margins were down from 50.8% of revenue to 42.8% of revenue, which is quite a big fall, and markets freaked out about that, and their share price fell like 45%.
Wow.
So falling margins are typically a sell signal. It's either that there's strong competitive pressure, which I think there is a bit in the buy now, pay later space because you've got a lot of entrants in the market now, or there's some structural problems, and that's those structural problems coming through with rising interest rates.
And so that's going to get harder to attract new business, obviously, because they're going to have to. In some way, they're going to have to pass those costs on, aren't they? Like through the service fee, that's going to have to go up. Do you think this is the end of the buy now, pay later experiment? in a sense that, it was like the great savior and the great alternative to credit and to credit cards and that kind of thing. Is it something that can only work in a really hyper low interest environment?
Yeah, maybe. I don't know necessarily about low, but maybe just stable. Like you sort of, you lock in your service fee around a particular interest rate. You're getting money at a particular price, and your service fee kind of works with that. But then if interest rates go up, if they just change, then that affects the margins that you're getting, and that's sort of what we're seeing. I mean, so there's that issue for buy now, pay later. There's a second issue, which is the credit quality death spiral. So. So we've got in an inflationary environment, so everyone's facing higher costs. Interest rates are going up, so that means student loans, car loans, mortgage rates are going up. Inflation's going up, so that's eating into the budget. So consumers are feeling the pressure. And then if buy now, pay later increases their rates to try and buffer up those margins, the more responsible users, or the users that don't have to use it, will just pull out. Because they've got other costs they've got to deal with, and the fees are going up for buy now, pay later. So they're just going to go, I'm just going to pull out of that. And that what that means is that the quality of your user base starts to degrade, because you sort of left all your good quality, your higher, your quality borrowers, the ones with high credit scores, they start leaving your service, and then you're left with a greater concentration of lower quality credit score users, which that creates a problem. And because the cost of capital for the buy now, pay later companies, that's in part determined by the quality of their loan book again in air quotes. So there kind of becomes a bit of a death spiral, because then that pushes up the rates for the cost of capital for buy now, pay later. So they have to increase their margins, which further pushes the quality borrowers out of the system again, which means their cost of capital goes up, which means they have to push up their prices again. And so you get this kind of death spiral dynamic happening. And I don't know how serious it is, but I think it's a bit of a problem for them. And I think the market has turned, like definitely sentiment has turned. They were darlings, but you look at, in America, the numbers are crazy. So Zebit is down 95% from its IPO. Lay-By is down 91% from its IPO. Zipco's down 77%. Sezzle's down 83% over the past year. So yeah, there's definitely a sell-off in buy now, pay later happening. And yeah, I think maybe, I don't know if it's dead, but I think fundamentally, it seems to me buy now, pay later is just credit in a different package. And credit's been around forever, so that's not going anywhere. Whether buy now, pay later as a way to brand and deliver credit sticks around or has to evolve, I'm not sure. We'll have to see.
It's tough too, because you mentioned, that you're going to have lower quality borrowers, subprime borrowers maybe you might call them. So presumably they're going to start defaulting on some of their debts too, right? So, but buy now, pay later, unlike traditional credit where you think of, if you want to go get a loan, typically there's a minimum kind of financed amount. So you got to get you want to buy a car, maybe it's 20 grand, or even a holiday, maybe it's 5 grand. There's usually a minimum. Whereas the attraction of buy now, pay later was always like, you could you buy now, you go buy a pair of shoes. Like if people start defaulting on their pairs of shoes, there's nothing you can go and reclaim and sell. Like you can't go, what are we just going to list a pair of used Reeboks on Marketplace or something? Like these companies have got nothing that they can claw back from the consumer. Like, if I lend you money to buy a car and you can't pay the loan anymore, I can just sell the car and at least get some of my money back. I imagine all of these companies that have just sold like fragrances and shoes and God knows what else on buy now, pay later are just going to be like, well, have you got any money? No, I haven't. That's why I used you. I used buy now, pay because I didn't have any money. I still haven't got any money, and I've worn out the shoes that I bought. So I think they're screwed. Yeah. All right, Thomas. Gary messaged us, I think it was via Facebook or Instagram, at CVE Podcast. Hey, guys, love the show. Don't know if this question is relevant to economics exactly, but for AU investors wanting to invest in US stocks, how should we view changing AUD into USD when the dollar is so low at the moment to buy shares? Does it matter, or is it all relevant to the time we might sell in the future? Thomas.
Yeah, the question is, the short answer is yes, it is relevant. If you're investing in US stocks, depending on how you do it, but like if you're going into like a US broker, like a stake in Australia or something like that, then you've got to convert your currency first when you deposit your money. And so the exchange rate matters there. Same story on the other side of the trade, when you bring it back, if you sell your holdings and bring it back to Aussie dollars, you've got an exchange rate sort of question there as well. So short answer is yes, it does matter.
Right. Oh, done.
Yeah.
Well, it happened a lot. I think there was a lot of this with the boom that we saw sort of immediately following COVID or after COVID. What do we have? The V-shaped during the recovery, and all the companies like Netflix and all the FANGs really took off. I remember there was a lot of people saying that they hadn't actually made a lot of money because of the exchange rate was kind of eating into a lot of those profits.
Yeah. It's sort of a question. On the long run, like I think you could potentially time it. Like you sort of know, if you're not too sensitive to it, and that's the nice thing about being a retail investor, you're not looking to get in and out too quickly. Like some people are, it depends on how you play it. But, the Aussie dollar typically moves within a band, like it gets down as low as 50 cents and it gets up as high as $1 something at its extremes. And then, over the long run tends to sort of oscillate around 70, 75 cents. So you got a fairly good idea of the range that it's moving in. It's not going to 25 cents. It's not going to $2, not anytime soon. And so you can sort of maybe load up when it gets to the top of that band. If it gets to sort of the high 80s or 90s or something, if we get that, and if it gets down into the mid 60s, maybe that's a good time to sort of bring some money back.
Aren't you effectively then just forex trading by proxy though? Like I'm gonna buy shares when the dollar's low, and I'm gonna sell them when the dollar's high. I think maybe forex trading might be the play for you if that's your go.
Yeah, but that's the thing, right? Like if you're investing in US shares, you are effectively taking a position on the currency. You are forex trading. You have a currency risk and your share price risk. You've got both of those. The question is whether you do it consciously or not. Like you might just go like, I'm just going to ignore the currency risk and just assume that it's going to balance out in the long run if I'm just sort of like consistently buying, American stocks when I have the chance, when I have the money, and then I'll just trust that it'll come out in the wash eventually, and I won't worry too much about it. You could do it like that. But you could also do it the other way. And some people do recommend, like when there's some traders I know that say, when Aussie dollar gets down to mid to low 60s, it's a good time to go for US stocks, particularly if you've got a good view on a US stock that you like. You're going to I'm going to take that stock risk, but I'm also willing to take the exchange rate risk because the exchange rate, given its sort of historical valuations, is looking pretty good right now.
Yeah. I had a look at the dollar's dropped it was about 80 cents a year ago, and it's now down to 72 cents. So, yeah, it's not huge, but it's going to make a bit of a difference.
So
what's the play then for is the dollar going to continue heading low? Is that what we're going to see?
This is the really interesting question right now, and it swings on terminal rates. So terminal rates is the developed world, pretty much the whole world, is hiking interest rates now. At some point, that's going to top out, and they'll stop hiking rates. The point at which they stop hiking rates is called the terminal rate. And so you're hearing a lot of discussion now about what's the Fed's terminal rate, what's the RBA's terminal rate. The interesting thing is, if you look at market pricing now, what the market's expecting rates to do, the US terminal rate is 1.87%. The Australian terminal rate is 2.47%. So it's like 50 basis points higher, 60 basis points higher, even though the inflation outlook is completely different. Inflation's running at 7.5% in America. It's 2.6% here. So it's a little bit hard to square that away. A lot of people are saying this is a bit of a puzzle. On that measure, in 14 months, Australia has the highest interest rate in the developed world, even though inflation's running very low. So it's sort of like it doesn't really make sense. But if that was to play out and we had a higher interest rate than the US, then that puts upward pressure on the US dollar, because if Aussie dollars are returning more, people want more of them, and that pushes the price up. So a higher interest rate differential in favour of Australia starts drawing money into Australia, and that pushes the Aussie dollar up. But I don't really know that many economists who think that that's going to play out. CBA is saying the RBA terminal rate's 1.25%. And so if the Fed gets to 1.87, close to 2%, we're at 1.25, that should put downward pressure on the Aussie dollar.
So the RBA's bloody lying again, are they? Are they up to their old tricks?
Well, no. The RBA's got nothing to do with this. This is markets pricing in. So you can track.
Yeah, but the RBA's weren't they the ones isn't it their forecast? Or is it the market's forecast?
The terminal rate? The terminal rate's the market's. That's what the market reckons the RBA is.
It's not the RBA.
No.
Right.
No, the RBA is keeping that to their chest. They're not keen to tell you where they think the terminal rate's going to be.
Why would they? No one believed them about interest rate increases before. So
the short answer to your question there is who knows. Like if the current price of exchange rate is based on the collective market's view of where the future of all of these factors, which means that they think that the current price is fair value. How the situation unfolds from here will determine what that is. But right now, that's the current price is always the market's best guess at what fair value is. Does that make sense? And that guess changes as circumstances evolve. So
it's convenient.
Yeah.
Can't tell you what's going to happen. We can only tell you what's happening right now. That could be the motto for CVE. All right, let's take a short break there, grab a word from this week's sponsor, and be back with more Comedian versus Economist right after this. Welcome back. You're on Comedian versus Economist. Don't forget, you can always send us an email, cve@equitymates.com, or via the website, equitymates.com/CVE. And you can also, of course, find us on social media, Facebook and Instagram @CVE Podcast. Thomas, there's a bit of trouble brewing at... Would have been so much better if this was a beer operation rather than a whiskey one. But anyway, there's trouble at Lark Distilling this week. The whiskey maker's CEO had to step down after footage emerged of him smoking what appeared to be an ice pipe. Now, Thomas, before we get into this, I just want to ask you, can I make jokes about it, or is that is anything off limits? I just want to gauge how open you are to sharing a defamation lawsuit with me. That's all, before we...
Yeah. No, you run your own show. I think we'll
all right.
Keep it at arm's length for a bit.
All right. Well, maybe you tell us what's going on at Lark Distillery.
Yeah. Well, no. Yeah, it was the managing director, Jeff Bainbridge. So Lark Distilling's a Tasmanian whiskey maker, publicly listed. He was the victim of a shakedown, in his words, in Southeast Asia in 2015. He was over on a holiday, and someone got some footage of him smoking an ice pipe, apparently. He said, "I attended a gathering with people I didn't know and don't remember much about that night.
hang on, was someone else holding the ice pipe?
I don't know.
It's a tough defence when you're sitting there. I don't know, let's leave that for the courts.
Yeah.
But
well, I don't think he's denying
I
it.
mean-
So, well, the next morning I was played footage which made it clear I'd been set up as part of a shakedown. And this was 2015, and since then he's paid them some money. He engaged a London-based threat assessment agency, and then eventually just stopped replying to the blackmailers, who then released videos to the media outlets. Yeah, and saying, although I consider myself a victim of a crime, I accept that I'm also responsible for the circumstances I find myself in. I'm a victim of extortion, but that wouldn't have occurred without my poor judgment. I'm deeply remorseful for my actions. So he is taking responsibility for it. He had stepped aside.
I think we certainly don't want to condone illegal drug use here on Comedian versus Economist. But I think you can kind of see, like if you work in a whiskey distillery all day and you get home and you want to relax, you're not going to feel like pouring yourself a whiskey, is all I'm saying. Maybe you feel like, I'll just go for a quick ride on the Polar Express and just unwind after a busy day of whiskey dealings. That's, I think we shouldn't judge him too harshly. But
Yeah.
because he's not, he's a whiskey dealer to begin with. Like he's not exactly starting at the top of Moral Mountain, are we? We're selling booze if we boil it down.
Yeah.
As I say, not condoning illegal drug use by any stretch.
Yeah, I mean, it's a tricky thing being, a public figure effectively, like as the managing director, and you're kind of in the news, and you got to front for the company, you got to meet with investors. I don't think it's like it's an issue per se.
You say it's just something to get him through his investor meetings. Oh man, I got this earnings call in 15 minutes. I might just.
No, but like if you're the managing director of a public company, you're representing the company. People want to know that they're investing in you. You're managing their money effectively.
Yeah, true.
They want to know that you're going to do a good job on it. That you're not going to blow it all on ice down at the RSL or something.
Yeah, true.
So I think that's where it became untenable.
It's an interesting question, though. Is how long are you responsible for the sins of the past? Because this happened in 2016, so
15, yeah.
2015. Sorry, so 6 years ago. So, and absolutely not the right thing to be doing. But that was before he was CEO. It was before he was working or involved, managing director. Before he was involved in this company. Maybe it was on his job description at his previous gig, like attend meth parties. And occasional travel.
He's part of a crypto startup.
That's how easily it can happen.
Yeah.
We saw it with Grace Tame as well. So she was there was that photo circulating the media recently with her sitting next to a bong. And that obviously photo was taken a long time ago, and it's the same sort of deal. Like, how long do you? Because there'd be incriminating photos of everyone, I'm sure, out there doing something to varying degrees of criminality or otherwise. So God, if some of my, I don't know, there's bound to be photos of me out there that I'd rather not get out. But because we're all a bit young and reckless in our younger days. Like how long do you kind of or is that just the world we're living in now, where you need to have a squeaky clean image from your past as well as your present? Yeah,
my sense is that this is shifting. This is my view. And I reckon Trump sort of brought this in, like remember that whole grab him by the pussy kind of quote? When that first emerged, everyone was like, that's it, he's done. That's the end of Trump. You can't, as a politician, as a presidential candidate, you can't be on the record talking about grabbing women by the pussy. But he just rolled with it and went like, yeah, that's who I am, And so I think the sort of the outrage, I think we might be sort of reaching a peak, and people are like, people just did stuff. And I kind of think as you're saying, he's the managing director of a whiskey company. He was on holidays in Asia somewhere. Some weird stuff happened. I kind of feel like most people are a bit like, yeah, I get it. You shouldn't have done it. Yep, you messed up, but Does it really affect your performance as managing director? Maybe people start to look through it.
On the Trump thing, though, I don't think anyone accepted that and condoned it. I think it was just he had a large supporter base that thought that made him cool somehow, which is horrific in its own way. And so, yeah, I don't know. I think to me that's a different thing. That's not forgivable. Whereas Grace Tame, for example, smoking a bong, you just go, that's reckless kind of. That's just something probably a lot of people would have done, when they're younger.
Maybe. I think it was interesting with Perennial Value Management. They own like a 10% stake in Lark. And so, Mr. Bainbridge quit and the share price fell from $4.55 down to $3.60. So they got a bit of a shellacking there. But Lark was like, yeah, whatever, this is fine, saying that said Lark is a 30-year-old company. Jeff was there for 2 years. And they've got a whiskey inventory worth $430 million at maturity, well ahead of today's market cap. And that was their statement on it. And so they're sort of saying like, yeah, it's a small issue. It's problem, whatever he's got on. That doesn't mean there's a problem with the company. And I thought it was really interesting they're pointing to the whiskey inventory at $430 million. So their Lark's market cap's currently $270 million. So their inventory is worth more than their current market cap. And it gets a bit like Warren Buffett's cigar butt stocks, if you remember that. So Warren Buffett talked about like when he was in his early days as an investor, he went after cigar butt companies, like companies that had a lot of problems, but they're like finding a cigar butt on the street, and there's only one last puff in it, but that because you got it for a bargain, that puff is all profit. And so Perennial sort of saying like Lark's a bit like that. Like even if they just wound up the company tomorrow, they've got that much inventory on hand that they're worth more than their entire market cap. So you can't really go wrong. So like, why would we get out? Like even if we thought this was a big problem with company culture and whatever, rather than just one guy messing up, even if that was the case, the inventory is worth so much that you can't really go wrong.
And maybe Bainbridge thought the same thing. He just was walking around at the party. He saw an ice pipe on the ground with one puff left in it, and he thought, just finish it off.
Pure profit.
Pure profit. All right, Thomas, finally, Christie's auction house is auctioning a doghouse. And it doesn't even come with a dog. And they reckon it's going to fetch $300,000 at auction. Man. What a good boy. I wish my dog would fetch me $300,000. Why is this doghouse so valuable?
Yeah, that's a special one because it was in Costa Rica and it got hit by a meteorite and put a hole in its roof. So it's a pretty no-frills looking shelter. It's pretty basic. As you expect the doghouse to be, just some like second-hand corrugated iron.
I don't think we should spend too much time explaining a doghouse to people. I think it is very much your run-of-the-mill doghouse. It just got hit by a meteorite.
Yeah.
Worth pointing out the dog is fine, though.
Yeah. Rocky.
Coincidentally, though, Rocky. Space Rock just missed Rocky, the dog. Right, so it got hit by a meteorite, and so what would have... You couldn't have given it away, probably. You wouldn't have. You would have got previously $20 for it on Gumtree or whatever. And now it's going to be $300,000.
Yeah. I mean, it has been mounted on an AstroTurf platform.
Oh, well.
Yeah. There's a lot of value add there.
Sign me up.
Yeah.
I wasn't interested at $20, but now you've put artificial lawn underneath it. $300,000 seems about right.
Yeah. I mean, like I didn't realize this, but like meteorite close calls are incredibly rare. Like no one has ever been in history that we know of has ever been killed by a meteorite falling out of the sky on top of them. There was one woman in Alabama back in 1954 who got hit by something and got a severe bruising. But yeah, because it came through her roof. But apart from that, that's it.
I'll be cancelling my meteorite life insurance policy there, that's for sure.
Yeah. Yeah.
Well, there have been some other... There's a bit of a precedent for this too. So there was a mailbox that was struck by a meteorite, which sold for some ridiculous figure.
83,000.
83,000, thank you. Interestingly, though, there was a meteorite that struck and killed a cow. And the meteorite, the rock that hit the cow, only sold for $5,000. So the meteorite themselves is not seemingly the thing that's of value here, which is a bit puzzling. It's the thing that it hit, which, in the case of the doghouse is fine. So, yeah, it was interesting that this cow that got killed by a meteorite, the rock only sold for $5,000. The steaks, however, $1,000 a kilo. That's not true. I don't know. Although I'd love to see that on an ad for like Hungry Jacks or something. You know how they describe how juicy and delicious their patties are? Just be like, we only use the finest cuts, the flame grilled, juicy, tender beef you can only get from a cow that's been smashed into by a meteorite. Like that's a burger that I would buy.
I think it's the cool factor. Like, if you have it in your mansion, if you're dropping 300,000, you've obviously got a mansion. You put look at this doghouse got hit by a meteorite. Maybe you're actually going to put a dog in it. That would be pretty cool. You can show your friends, look at this doghouse got hit by a meteorite. It's not as cool like to be in the study going, look at this rock. This rock fell out of the sky and killed a cow. Everyone's like, oh.
Yeah.
Oh,
that's a bit morbid.
That's sad.
But you'd have to have a sign in the front of your house, the doghouse inside your mansion, that said, like, the dog was okay. You'd need that disclaimer, because if you just got like it's a pretty grim looking scenario. It looks like something out of like CSI Miami or whatever, where it'd just be like, it looks like a murder scene where there's just an empty doghouse with a meteorite hole in the roof. Everyone would be like, oh man, it must have been the house his dog lived in until it was killed by a meteorite. He's obviously kept it as a shrine to his long lost best friend.
Just put some police tape around the outside of it. A little chalk sketch of the dog out the front.
Yeah. All right, we better wrap it up there. I've got to go and move my doghouse onto the lawn. Thank you so much for joining us once again on Comedian versus Economist. Don't forget you can check out a range of great shows across Equity Mates Media. Get Started Investing, Equity Mates Investing Podcast, You're in Good Company, Talk Money to Me, Crypto Curious, and just another reminder once again to join us for the ASX share market trading game. There's still time to register. Get involved and have some fun. That's it for us. We'll talk to you again soon. See ya.
Comedian vs Economist is a product of Equity Mates Media. All information in this podcast is for education and entertainment purposes only. It is not intended as a substitute for professional finance, legal, or tax advice. The hosts of Comedian vs Economist are not financial professionals and are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. For more information, head to the disclaimer page on the Equity Mates website, where you can find ASIC resources and find a registered financial professional near you. In the spirit of reconciliation, Equity Mates Media and the hosts of Comedian vs Economist acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander people today.